Welcome back. In our analysis of the fixed income market, we take a look at the 10-year U.S. Treasury minus federal funds. It gives us some pretty interesting insight into the current market trend and overall economy. It's telling us something quite interesting as of late, and this is why we want to talk about it. Now, what it is, it's the 10-year U.S. Treasury bond, the yield, minus federal funds rate, which is the interest rates. The red line over here shows us a 10-year U.S. Treasury. That's in red. The black line across the top, that's interest rates. That's at 5.5% going back, quite a while. This chart goes back to the end of August, so for several months. The white histogram bars show us the spread between the two, the 10-year U.S. Treasury minus federal funds rates. And what we can see over time is that as the 10-year US bond goes up, so do these histogram bars. When the 10-year US bond goes down, these histogram bars go down as well. So again, it just shows us the difference between interest rates and the 10-year US Treasury. Now, take a look at a little bit of a longer term perspective. This goes back to October of 2021. The red line is US 10-year US Treasury bond. These are the yields, of course. The white line is federal funds rate, interest rates. And what we can see, and the black histogram bars at the bottom show us the 10-year minus federal funds. And we can see early 22, we see the red line, the 10-year US Treasury was above the white line interest rate. So these histogram bars were in positive territory. And when the spread between the two really narrowed, that's when this black histogram bar dropped down. Eventually, federal funds rate crossed above the 10-year US Treasury, and that's when we went negative. And we can see the depth of how negative we were, about at 1.75% below, meaning 175 basis points, that federal funds rate were above, or is currently actually still above the 10-year US Treasury bond. This started mid 22, right around the same time as the beginning of the inverted bond market, and still persists today. Now, lately, what we've seen is the red line, the 10-year US Treasury, move to the upside and approach interest rates. And that's when these histogram bars start to move up back towards the zero level. But recently, they've really dived back down. Just the other day, the 10-year bond hit 5%, which is a very, very historic level. But since then, interest rates have bounced back down to the downside. And that's why these histogram bars have also fallen. This goes back to 2002. Red line, 10-year US Treasury, white line, interest rates, the black histogram bars, that shows us the spread between the two. Notice what happened. 2005, 2006, the economy was very strong. The 10-year US bond was going up. The Federal Reserve says, hey, the economy is kind of strong. Maybe it's too strong. Lots of inflation. Let's raise interest rates, which they did. As they rose interest rates, as interest rates rose, and they eventually crossed above the 10-year US Treasury, that's when we dipped into negative territory on the spread. This is one of the takeaways. When we see the spread in negative territory, it shows us a couple things. First of all, the economy is very strong. The 10-year US Treasury bond went up, but now the Federal Reserve has raised rates to such an extent that rates are actually higher than the 10-year US Treasury. That's what this shows us. And this usually coincides with very strong markets, very good economics, very, very strong economic conditions. Usually, we know from history when we have very strong economic conditions and very strong markets, well, that usually comes to an end as well. What happened was the Federal Reserve saw all of this inflation rose and interest rates rose, but eventually that started to slow the stock market down, slow the economy down, and then the Fed cut interest rates. Take a look to see the white line, how fast it went down. When the white line crossed back below the red 10-year US Treasury, the spread went from negative to positive. This coincided, by the way, the end of 2007 with the real beginning of the financial crisis. Well, fast forward to present day, what has happened? Even before present day, we know back in 2018, Federal Reserve rose interest rates, and then at one point they actually crossed above the 10-year US Treasury. Now, it's not really important which direction each line is going, but rather the relationship between the two. So at this point, the 10-year US Treasury was already going down, and then the Federal Reserve decreased interest rates because the economy is starting to slow in 2019. Now, fast forward to present day. Federal Reserve skyrocketing interest rates, crossing above the 10-year US Treasury, and that's why we see this spread in such negative territory. Also, compare this spread at almost 2% to the spread of 2007, which was almost 1%. We have a double spread here, meaning that the interest rates are 1 percentage point, 100 basis points higher than the 10-year US Treasury than they were in 2007. That shows you to the depth and how much the Federal Reserve has increased interest rates. Now, this chart goes all the way back to 1963. This shows us very simply the spread, 10-year bond minus federal funds rate. And we can identify extremely strong markets that led into very extremely recessionary markets. Early 1980s, lots and lots of inflation. Federal Reserve had to raise interest rates. We had an 8% spread at that point, where the 10-year US Treasury was below federal funds rate. That's because of how much the Federal Reserve had increased interest rates. We had a minor recession going back to 1990. Then, of course, the tech bubble that burst around 2001. We had 2008 financial recession, which on this chart really doesn't even look like that much of a recession. We know it was the 2018 dip, and then where we are present day. But where we are present day at the depth of our spread was more than 2018, more than 2008, more than 2001. In fact, we have to go all the way back to the 1980s to see such a spread, such a divergence between the 10-year bond and federal funds. Here's a different way to look at it. The black histogram bars in the background, that's the 10-year minus federal funds rate. The white area chart, that's federal funds. So we notice 2004, 2005, this is the point when the federal funds rate exceeded the 10-year minus federal funds. This really shows us the very hot markets, and that shows us the inverted spread when the federal funds rate was above the 10-year bond, and we know how 2008 ended. This occurred again in 2018, 2019, and then, of course, where we are here. It just shows us again to the severity of the inversion of the spread between the 10-year bond and federal funds rate. Now, this time we take a look at the stock market. The red line's the S&P 500. And focus on here to show us the timing. The stock market was very strong 2005, 6, 7. That's when we had this inversion. The inversion is not the signal to sell short. The inversion is just telling us very simply that the Federal Reserve has raised interest rates. They see inflation. They want to cool things down a bit. That's what this inversion over here tells us. And eventually, when the Fed started to cut rates, that's what caused this spread to skyrocket. When the 10-year bond started to drift back above the federal funds rate, or better said, it's that the federal funds rate dipped back below the 10-year bond. And by the way, the secondary reason, or explanation why the Federal Reserve is cutting interest rates? Because they see the economy slowing. So the real trigger here is not when the Fed raises rates, but when they cut rates so the spread turns back positive. That's what we're looking for is this moment when the spread turns positive. The spread turned positive again in 2019. Has it happened again yet? Not recently. But that's why we're keeping such a close eye on it because a 10-year bond rallied to 5% to a point where the spread was almost positive. But we know historically, when the spread turns positive, it's not because the 10-year bond's going up. It's because the Fed is cutting rates. And that's really the trigger we're looking for. Zoom into where we are now, S&P 500, present day. We're rallying back up. We could say, oh, and maybe there's a trend line over here. But we see the spread almost came into positive territory, 50 basis points from being positive, but then the 10-year bond fell. But again, the real signal we're looking for is that when the Federal Reserve starts to cut rates and brings interest rates back below the 10-year bond yield. Zooming in now where we stand, this is the 10-year bond. That's the red line. The federal funds rate's at a static 5.5%, and the white histogram bar shows the divergence between the two. So the 10-year bond is moving up, obviously, in anticipation of higher interest rates, lots of inflationary pressure, that sort of thing. But what we're really looking for is for the economy to cool, but not just to cool, because if the economy starts to cool, if we see poor jobs numbers, they actually were really poor. If we start to see inflation numbers come back down and all those other great things start to come back down, we want to see the Federal Reserve cut rates faster than the 10-year yield drops, because the 10-year yield will drop when inflationary conditions cool. But we're looking for the Fed to cut rates faster. We usually discuss this around once a week, the position of the Fed funds futures and what they anticipate in terms of future interest rate hikes or cuts. We're going to talk about that in the next couple of days. So far, it shows us the Federal Reserve is not due to cut interest rates until about June of next year. But that can always change. And that's why we watch the economic calendar so closely. So we're going to keep a special eye on this, but please make a mental note. Make a note of the 10-year U.S. Treasury bond, the yield, and where federal funds rate are right now, 5.5%, and the spread between the two. If we see Fed funds drop below the 10-year bond, that should be something we should make a special note for, because historically, that's usually a sign of something big to come. We hope this has been helpful. We look forward to seeing you back soon.